Well, before I start, first of all, thank you very much for having us here. And I really want to express my gratitude to all of you for taking time out of your very, very busy lives, for being here to learn about really the challenges we are facing, about the actions we need to take, and how each and every one of you can be part of the solution. So thank you very much. Cambridge Associates, who are we and why am I here? So my name is Lydia Guett. I'm part of the ESG investing team at Cambridge Associates. We are a global investment firm really working with endowments, foundations, but also pension funds and families to manage their portfolios. The origins of the firm are really the two founders did an MBA at Harvard, and in the summer they decided to look at the Harvard endowment at the time, which really didn't have, there was no one actually looking at endowments and foundations from a portfolio management perspective. So they were the ones who, with along other US colleges and universities, institutionalized the endowment model of portfolio management. So we've been doing that now for over 40 years. And if you know a little bit about, for example, Harvard or Yale, they usually have two objectives. So the endowment, on the one hand, should grow, but on the other hand, they should provide a stable inflow of capital to support the organization. And within this context, endowment model has four basic characteristics. One is it's equity-based. It invests in asset classes that are illiquid, more complex. It's value-based investing, and it's about diversification. Very interesting to look at the very beginning, 1970s, 1980s, where this all started. Those large endowments, they really started from a cash, bond, and equity allocation. Very much the 70-30, 60-40 allocation we see among many pension funds today. So they embarked on a journey to diversify the portfolio to improve the risk-adjusted return. They first started with some illiquid investments, first looking into venture capital mainly in the 80s. In the 90s, they diversified further to then very unconventional equity and equity-like strategies, looking at emerging markets, looking at hedge funds, but also further diversifying their illiquid part of the portfolio. As we see the asset allocation has now more or less stabilized over the last decade. Very interesting is that the co-allocation to equity and bond and cash as well has decreased in favor of more illiquid strategies. Again, this is venture capital, this is buyout, this is distressed, so very interesting strategies here. So what does that mean from our return perspective? We have a long-term time horizon, and that really is the key advantage of those endowments. So they can take advantage of market inefficiencies because they have a multi-decade investment horizon. The added value is stable, but you do see some short-term cyclicality. The question now is, we've seen hedge funds, we've seen real assets, we've seen private credit, co-investment. What's next? So why endowment modeling 3.0? Well, the future is ESG investing. It's very clear. If you have a long-term investment, as we've heard today, you must consider ESG factors, not only from a risk management perspective, but alpha generation is key here. So as we all know, there are many different acronyms on how to define ESG investing, impact investing, SRI investing. But what is really, really important that all of these have something in common. There are some key trends that we see, and we think they are directional and non-mean reverting. What do I mean by that? It's the digital revolution. It's the pressure on resources. It's about public opinion. We know that now public opinion is global and it's instant. It's very difficult for companies increasingly to hide their bad business behaviors. So that's a clear shift, and that's something we also see in our discussions with clients. So endowments and foundations used to maximize their return with their endowment to then give out more grants and make a bigger impact. But now their thinking is shifting. First of all, they don't want to invest anything that is completely misaligned with their mission. Then they're looking into making a positive impact already with the main endowment. That's fantastic to see. We look at families where the next generation is really driving the discussions. They are really asking their parents, well, what do we own? And does this align with our values as a family? They're questioning their family, they're questioning their advisors, and really, really start to understand what they own and whether that's the way forward for them. And finally, pension funds, quite interesting. We've seen specifically the UK regulator mandating trustees to consider non-financial but financially material ESG considerations, specifically climate change risk related, in their investment decision making. So there is a discussion that is starting, and it's a first step, but it's really important that this gets to regulatory level. We have seen the demand the demand side is shifting, but also the investing is shifting. So we started from a space where we were excluding. So we were excluding the sin stocks, we were excluding tobacco, we were excluding fossil fuels. We then looked at leaning into solutions, renewable energies, for example, energy efficiency, storage. All of this is very interesting, but where is alpha generation? Really, it's in the sustainable investing. So in finding managers that look at the investment universe with a completely different mindset. For them, it's completely natural not to invest in fossil fuels because there's just no alpha generation in the future. It's really about investing in better run companies because you think they will make a better long-term return. From a portfolio management perspective, there are many different ways, some of which we discussed already. Well, the first step is compliance. What we see very successfully is a carve-out, so dedicating a certain part of the portfolio towards impact investment with a specific aim. This really starts the discussion internally. It's about committing and seeing the successes, and then, as we heard as well, moving that forward. For sure, the full integration across the entire portfolio is the holy grail, but some investors just need a little bit more time to get there. Looking at the space, well, we see demand has probably in the 24 months increased exponentially, but supply as well. Every single manager we talk to is completely integrated. They've done ESG for decades, that's all they do throughout all their products. They learn to speak our language, and that's actually challenging for investors. So how do you know that they're actually integrated? How do you know that it's not just an add-on because it's cool, because it's hot, and because the investors demand it? So looking through is absolutely critical. Understanding what are the holdings, understanding how this feeds back into the marketing message they have. So really doing your diligence, both on the investment side, don't compromise, plus on the impact investment side, or on the impact side, and in terms of additionality as well. So just looking at a couple of case studies to give you comfort, we can do this, we can do it well, and you can drive outstanding returns with an approach that's focused on impact. So we've been working with a couple of different clients, looking at the foundation. They were divesting from fossil fuels completely, and at the same time leaning into what's solution. They are very interesting mandate because they are not afraid to back first-time managers and first-time funds. They really want to drive the market. Another foundation family client, they are looking at environmental sustainability, so really driving throughout the entire portfolio, throughout asset classes, environmental impact focus with very key metrics on how the investments have to perform. So in conclusion, I think it's very clear that the endowment model itself is evolving, the industry is evolving, and we're now at the tipping point where we can make it work together. We can actually build an entire portfolio, globally diversified, across asset classes, in very interesting areas that drives fantastic returns. But ESG data is evolving, and you need to evolve with it too. You need to be up to speed how to measure investors, how to measure asset managers on ESG criteria, on climate risk metrics. So this is an evolving space. We are all part of the evolution, and we all have to drive the evolution further. This is not the end. This is not stale. This is a very dynamic space. And every one of you has a responsibility to ask the questions and to really challenge your investors, your advisors, and your peers. So with that, I leave it. Thank you very much.